Hi everyone, this is Rob Roy and welcome to the Elliott Elite U.S. Market Update. And boy, what a week it was. We had seen just the chink in the armor last week in the recording, but this week we saw the big drop, and boy, the financial networks were having a field day with the volatility. You've heard us for weeks and weeks talking about all the indicators that were showing that we were beginning to get just a bit too complacent, a little bit too on the optimism side, if you will, and topped it off with what we showed in last week's report, where we had this move that was more of a 45-degree angle, and then we kind of went vertical. And when things start to go vertical, that's when you start to get concerned, at least if you were on the bullish side of things, because when things go straight up, they quite often come straight back down, and that's exactly what happened. We had talked about the fact that there may be some support in this area here on the SPX due to the fact that we went sideways for a number of days, a couple of weeks actually, in December towards the end of the year before we took off on this vertical move to start the new year. But we kind of have a little bit of congestion there, but we were able to move through that and get a little bit lower. And when you look at the Elliott wave pattern here, you look at the fact that all we have here is a 50% correction in a very long wave 3. So nothing alarming at all on the Elliott wave chart. This is just the normal course of business, and we'll talk about this in another minute or two. But when you're looking at your indicators, what indicator has been more accurate in what's gone on in the markets than Elliott wave? None that I can find, and I look at a lot of them, and I've looked at even more than that over the years and settled into just a handful that are led by Elliott wave. Why am I still looking at Elliott wave after all these years? Well, you just saw the reason over the past couple of weeks, and you've heard the reason over the past couple of months with all our recordings in talking about what the market was showing based on an Elliott wave pattern. Now, are we done with this wave 4 correction? Well, remember, we're only at a 50% correction, and with Elliott wave we could go as low as a 61.8% fib correction. So not ready to call that this is the actual end of the wave 4 yet. Usually when you have a move that's this severe and this volatile, there's a lot of bouncing around and consolidation that occurs in order to build a base to move on. V bottoms are very rare, and that would be meaning that we stop here and then just move directly to the upside, creating this V look right here. They do happen, but they're very rare, and especially when you've had this kind of volatility, you'd be looking for some sort of a basing here at the wave 4 before we start off in that wave 5 move. But again, we could go lower from here before we even start the basing program. We'll just have to wait and see. Looking at the SPY to bring volume into the mix, as you would expect, significant volume on this downward move. When you get the volatility, that usually comes with volume because people become scared and they panic and they run for the exits, and you see the excess volume, and that's exactly what occurred here with this massive volume. We had talked about how this increased volume on the vertical move was a bit of a warning sign that the smart money begins to exit early. And just go back and listen to the previous recordings, and you can see that we've been pretty spot on in analyzing what Elliott wave, price to volume action, etc. have been showing us. Let's go look at the VIX, the volatility index. We certainly got a massive spike. We had talked about this triangle that existed way back down here. And this is dealing with Elliott wave corrective patterns, which I'm also going to talk about a little bit more here in this recording. There was our triangle, and we got the breakout from that. We had a little bit of consolidation, came back down, tested the breakout, and then boom, off to the races. Now I want to be clear here. Now this little triangle here did not forecast this entire move of volatility. That would not be accurate in order to state that, but it did show that a breakout of volatility was coming, and obviously it was more severe than most people expected. Even myself, who's been looking for this for quite some time, expecting this volatility to come out. There's a famous quote that I wanted to share with you from Sir John Templeton, who's one of the founders of mutual funds. He's been around forever, was around forever, and it says, bull markets are born in pessimism, they grow in skepticism, mature in optimism, and die in euphoria. So did we reach the euphoric state yet, to where this is the end of the bull market, that it's over with? Well, if we look at the Elliott wave, again, it's not saying that the wave 4 correction could be over, but it's certainly not showing that the entire Elliott wave pattern is over yet. So perhaps we didn't quite make it to that euphoric stage yet, but we were certainly getting close, weren't we, with the sentiment indicators that we've been sharing with you, not only the VIX, but that investors' intelligence number that I was talking about on the widespread, how we had gotten to the point where there was a greater distance between people that were bullish and people that were bearish from an investment advisor standpoint than we'd ever had in history. And when those types of things happen, that's why I bring those to your attention and talk about them, is because historically they've worked. I've been doing this for over 20 years, and all I'm doing is sharing with you experiences in history. That's it. I'm no genius in any way, shape, or form. Just been around for a while and seen a number of things, and want to share things that have occurred over time so that you're aware of them. And if you've been following along with us, you should have been well positioned in order to take advantage of this move. Our subscribers actually had call options on the VIX. Can you imagine how well those did? I mean, some people, we took ours off and then sent the alerts out, and some people, just due to the fact of how fast the VIX was moving, you can see this day here on the 5th of February on how vertical it went, and it closed almost on the high. Those that took a little bit longer, by the time they received the alert, processed their own positions, etc., made significantly more than we did. But that's a great thing when that happens. But all it was following along with the chart, and specifically this Elliott wave corrective triangle here, showing that we were due finally for the breakout in volatility. And I also wanted to show you something else, because boy, there's been an awful lot of talk on signals that have been going on. You're hearing a lot of talk about inflation, etc. But we talked about the fact that bonds, having a rising interest rate environment, is one of the worst things for an equity market and an equity rally. And we've introduced you to this symbol TNX, which is a ETF representation of the U.S. 10-year note, which is basically bond prices, treasury prices on the 10-year. And you can see that we had the wave 3 here. I've already gone and put in some of these lines here, just because I didn't want to spend that much time for you to watch me to draw lines. But in this pattern here, we can go back through and label these, because what we have here is a series of flats. So we have the A correction here, followed by the B, and then the C in this first flat. So that represents the first flat, and then we went right into a second one, and I'm going to share with you where the warning sign was here for the next move to the upside. There's the B, and then the C move for the second flat. So we had back-to-back flats in this little area here of consolidation. And then what happened right here was we didn't get the move from this point all the way back down to the support level. And if we were going to move into a third flat, we should have come back down here to start that A segment of the next flat. And the fact that we didn't, that we stopped here and started to head higher, and then we broke in this area, and we talked about this breakout from resistance, that was the sign that the flats were over, and we were likely going to continue higher in the wave 3 for interest rates. And interest rates moving this vertically certainly played into the fact of the market running for the hills at the first sign of any sort of trouble. And I also wanted to look at our fib levels here, aside from the primary Elliott wave, which is the 5-wave pattern. Let's just go ahead and take that off, and we've shared these tools with you that are so valuable within Profit Source and Integrated Investor, and we can look and see here, nope, we didn't get a 38% correction there, nope, we didn't get a 38% correction there, we got our first 38.2% correction. So that was where we were looking at for one of our zigzag patterns that we've talked about. So there was the wave A, and then the B correction down here to the 38.2% level, which means that from there we're looking for at least the first target is a 61.8% extension, and we blew through that, but notice how we were sideways here. Look at the congestion that we had here. Why did we have congestion there following the breakout? Because it's right at these fib levels. We ran right into 61.8%. We bounced back and forth between that and the previous level, 50. This could not be any more classic Elliott wave price action if we designed it ourselves. It's perfect. And then what happened? We broke above it and ran straight to the 100% extension. And then we have a little bit of consolidation building here right on top of that level. Does that mean that bonds are going to, or interest rates are going to run up to this 161.8%? No, we're already in an extended C wave of this zigzag pattern just by going to the 100% level, because remember, it was a 38.2% correction. So the 61.8 was the first target, so we already have a qualified, completed zigzag pattern. The 100% extension reach means that we are in extended wave C, and we could continue up to the 161.8%. We don't have to. We do think that we will head up that level. We've talked about this before, that it's likely with where the 10-year note is approaching 2.9% interest, that hard to imagine it getting this far and not going all the way up and bumping its head against 3%. But we'll have to wait and see, because things don't always work perfectly. But as far as the technicals with Elliott wave, it's just textbook stuff that I'm sharing with you. So there's nothing that has occurred over the last couple of weeks that should have been surprising to anyone. And if over the past several years you've abandoned your Elliott wave practice, or perhaps not put as much time or effort or emphasis in it, I encourage you to get back involved in it, because we're hearing, so many excuses. We actually had gotten to the point where people were saying that, and even a guy that has an oscillator called the McClellan oscillator had said that we weren't going to see any sort of a correction this entire year based on his criteria. So you're hearing all these different things and these indicators that people have relied on, and nobody was calling for the kind of volatility that we've seen, other than just following along with what we've been sharing with you in good old-fashioned Elliott wave. And that's why I've said that I have a number of indicators that I look at, and I've created a trading system. But if I was told that I could only use one indicator, it would be Elliott wave. So I hope that you've been able to profit off of this volatility, and that it hasn't spooked you or hurt you in your own accounts. But please follow along with us, because we are going to educate you over the next several months and years, just as we've begun to over the past weeks and months. So I hope everybody had a wonderful week, and we'll be back to talk to you again next week. Take care, everybody.